Good morning, everyone. Today is Tuesday, December 1st. I have no idea how it's December already, but we hope you enjoyed your Thanksgiving holiday. I'm Jo Ann Koontz, and I'm here with my partner, Marina Parkin. We are going to bring to you today some tax planning tips as we round the corner to the end of the year. It's a good time to start getting everything together rather than on April 12th. Let's do it now. It's a much better plan. So we've been kind of in the spirit of planning. We were doing planning with John Cipher 2 weeks ago, and then we planned to be off for Thanksgiving, and then now here we are planning for the year-end taxes. So without further ado, I'll let Marina get started as we launch into our laundry list of things we want to see from you before we get too late into the year. And tax planning, by the way, doesn't start don't call for your appointment on December 20th, right?
Absolutely.
That's the first planning tip of tax planning, is don't plan to do it the week of Christmas.
You got it, Jo Ann. In fact, that was one of the first things that I wanted to mention.
Sorry, did I steal your thunder?
No, this is perfect because it just reinforces the point that you really do need to start thinking about it earlier. This year does present quite a few challenges in terms of tax planning. There's quite a few people, and it's not just with us. I'm talking to a lot of my other colleagues at other firms. There's quite a few people that still don't have their 2019 taxes done. I think what happened is people were kind of in that funky state during COVID when it was lockdown time. And instead of kind of working on their 19 taxes, they were, doing other things. And what happened to a lot of our clients is once they came out of the lockdown, their business picked right back up, and they were so busy working that they still hadn't had time to put their 2019 taxes together. So I had looked at my list, and every year there's people behind, but this year it seems like there's quite a big bunch that is still behind, and people are still sending their tax information to us, which makes it very, very difficult to do 2020 planning when you are still working on the 2019 tax return. And like I said, it seems like it's across the board. Because it's just been a really, really challenging year. Another part of the challenges, of course, is the ever-changing tax laws. The tax laws are still changing. People are worried about what's going to happen with a new president coming in. Are we going to get a whole new set of tax laws? And, all we can tell you is we'll just keep our eye on it and bring you the latest updates. This is what makes planning this year, and we have been in planning mode, I would say, pretty much since the extension season has finished in the middle of October. So I had a lot of appointments in November and still coming up in the next couple of weeks. But what really makes it challenging is this uncertainty with what's going to happen in tax law. So last year planning was easier in that we kind of knew what that Tax Cuts and Jobs Act was about, and we knew we had it until 2025. So we had a couple of different strategies, but this year we are still planning with that in mind for 2020. If there's going to be any change, it may be retroactive, it may be going forward, but I think we just need to work with what we have. A lot of the strategies that we're talking about are particular to the CARES Act that came out during COVID time. And so the way that I sort of organize my thoughts today is things that are specific to 2020 as a result of CARES Act, and then some general planning ideas that are kind of good in any year. That, you forget some of those basic things that it just works, whether it's a timing difference on when to recognize income or push expenses. These are things that are relevant every single year, and they really are very, very relevant this year as well, as some of our clients are still recovering from this, and other clients are really making a lot of money this year. And so it's just been looking at every situation. Case in point. So I guess the number one planning, like Jo Ann said, is get the planning done. The second thing really that I wanted to highlight is, and this again is relevant every year, is put your information together as early as possible. So don't wait until March 12th for your March 15th deadline or April 10th for your April 15th deadline. if you want to plan and you want to have an idea of what your tax liability is going to look like for 2020, work on this now. You've got 11 months of data currently. So put that together, go through your income and expenses if you're a small business. If you're an individual, we'll go through some of the planning things particular to an individual, but just get organized. And I think that is never a bad idea. And tax planning starts with an organized set of documents. You don't have to have all the T's crossed and I's dotted, but you need to have a good idea of where you think you're going to end up in terms of your income in order for you to even estimate what the tax on that is going to be. So if you're all frazzled and you don't know where your receipts are and you still haven't put them together since February, this is your number one step. It's not going out and buying a new car that you can deduct. It's figuring out where you stand first before you go and buy that new car. So that I really wanted to highlight that, and before we kind of start into any specifics.
Quick question for you though. When you said you need to be organized and you need to have your information together, is there any particular software or method that you prefer to see that in as the recipient of that information? Do you love a shoebox? Do you prefer
I do not love a shoebox. In the words of my partner here, Jo Ann Koontz, if you're bringing me shoebox, there better be shoes in it.
That's right.
There better not be any receipts in it, that's for sure. There's a lot of different systems depending on how organized you are. As let's say we're talking about business owners. As a business owner, your best bet may be just to get a bookkeeper. And the bookkeeper, we're talking about how valuable your time is. If you're going to go out and get that new client and get that new sale and spend time running your business, let the bookkeeper for a couple of $100 a month, more or less, depending on how complicated your situation is, get all your stuff ready, enter everything into a bookkeeping system like QuickBooks or whatever the case may be, so that at any given point in time, you can pull your income statement, your balance sheet year to date. So we kind of start with that. If the client still insists on doing it themselves, I really don't recommend a QuickBooks for a non-bookkeeper person. So if just do an Excel. Get an Excel, set up different expense categories, set up kind of a spreadsheet schedule where you have month January through December, and then you set up different categories, and then you just record your total for that month. So you have a little folder. At the end of the month, you sit down and you record, tally up the expenses in that category, same as your mileage and on and on. And that goes a long way, because when you get to the end of the year, you can easily tally those expenses, and you get to sort of an approximate net income number that you can now work with for planning purposes. So Excel works really, really well with the clients that still refuse to get a bookkeeper or still prefer to do it themselves. There is other kind of in-between systems like FreshBooks, for example, is pretty good. We have a couple of clients on it. It's an easier version of QuickBooks in that you basically download bank activity and it set up categories, and it helps you categorize it, which then can convert to Excel, and then you can email it to us at tax or planning time. So those things are good. And I mean, you can Google around and find different things, but I think that if we go from QuickBooks being sort of the most advanced, I would say, and FreshBooks like for an intermediate, and then Excel for more simple. I still have a lot of clients who have envelopes and they tally everything up on a piece of paper and bring it to me. And guess what? That's very organized as well. It's not receipts lying everywhere. It's in one place. I don't care if it's the back of the napkin.
It just needs to be done. It needs to be done consistently and in the same way and frequently. So it's better to have a simpler system that is colored construction paper with your categories, and you actually use it, than to have QuickBooks with a pile that you haven't touched. So people will feel like, oh, I have QuickBooks, but if your QuickBooks is empty, you still don't have anything. So
I tell my clients that all these things are a tool, okay? And so you pick the tool for the job that you need done. And QuickBooks is a tool. You having downloaded QuickBooks is not going to miraculously create a bookkeeping system for you. You have to actually use it.
It's like downloading My Fitness Pal and not going to the gym. Like, you will not be skinny if you have a fitness app. You will be skinny if you get up and go to the gym.
Absolutely right. That's absolutely correct. And I have clients asking me, should I go and take a QuickBooks course over the weekend? And it's, you know, if you really want to punish yourself, yes, go and do that. But if you are so...
You'll appreciate paying your bill more when you do pay the bookkeeper, because you'll be like, I don't want any part of this.
Exactly. You will see the value of what the bookkeeper actually does a lot better. But if you really do want to work over the weekend and you don't want to rest, go and do the job that is your business. If you're a realtor, go and spend that weekend advertising and showing houses and contacting your client list. Do the stuff that will, at the end of the day, make you money. Not spending this, spinning your wheels, trying to learn something that is really not pushing your business forward. Because at the end of the day, you still have to spend time putting the system in place.
And John would yell at you. John, business coach John, would say, "This is, you're not playing at the top of your game. This is not the only thing that you're the only person who can do this. So we need you as the business owner doing things that only you can do." And sometimes people, especially early stage business, will say, well, it's cheaper, but sometimes it costs you more in lost opportunity and in lost ability to really work on the business and put procedures in place and systems in place that you could be doing before you're completely swamped, instead of trying to, you know, mess around with QuickBooks. It's definitely not for the faint of heart. I mean, we're accountants and we don't do the bookkeeping. We even have a bookkeeper. So
we don't do, and I tell this to my clients all the time, we have a bookkeeper. We have a bookkeeper. And if I did not have a bookkeeper and I spend my time, instead of doing taxes or tax planning for my clients, doing the books, that's not the best use of my time. So we actually have a webinar coming up. I believe it's sometime in January, as people are getting ready on how to present information to your CPA. So we're going to touch a little bit more on this, but this is kind of a good overview of, we just can't say this enough. And the clients that have been with us over the years, I feel are a little bit better trained, but we have a lot of new clients coming up next year. And I just really want to highlight that the better organized you are, the better your tax return is going to be prepared, the more time we can spend actually planning and strategizing at year-end time and tax time, instead of adjusting entries and getting your books up to par.
Well, and another point to that is you're actually going to save money, because if you are contemporaneously keeping your books rather than sorting through the shoebox at the end of April, what you're going to find is you will capture deductions that you otherwise would miss. So it's not only, you know, helpful for decision-making purposes if you want to run this like a business. Do you think Google sits till April to figure out if they made any money? Of course not. That's, you know, the more you are involved and the more you are staying on top of that, the better business decisions you can make about whether an expenditure is the right reason to spend the money. Like John always says, the QuickBooks tells you what you spend, it doesn't tell you why you spent it. So we need to pull back and have an opportunity to review those things. But also importantly, we have found over the years that after the return is done and someone is displeased with the level of tax that we've reported as due, then they go back and they find more expenses, because that's code for I bothered to look now. And if you were keeping track of those things over time, you would not, you would actually save more tax that would pay for the bookkeeper just by having this done contemporaneously.
This is the conversation we have for the last couple of weeks with all my tax planning meetings with my small business clients. This is exactly what we're talking about.
Now, Marina, you mentioned that upcoming webinar for how to present your information to your CPA. Courtney to the rescue says that's January 12th. And Miss Marion is looking for Santa to bring her a bookkeeper for Christmas. So I don't know if she was naughty or nice, but we'll see.
Miss Marion, I think we may be able to help you. I will put on my Santa hat.
Giovanna's a great bookkeeper. Everything will be 4.
Actually,
4.5.
I'm a great bookkeeper as well. Miss Marion taught him well.
There you go. There you go.
Well, I wanted to kind of dig into some of these planning ideas. And the ideas that I have, of course, are not all encompassing. And if you Google and you read and you stumble upon all of these guides that are being issued now, you will find these ideas, different ideas. The ideas that I'm talking about are the things that we see with our clients that are most commonly used currently. And this is kind of what's been very successful. So the first set of things I'm going to go through are tax planning ideas that resulted because of the CARES Act. So this is brand new, and this is what you can take advantage of in 2020. So let's get going. The number one thing is of course, many of you know the required minimum distributions from your IRA are not required in 2020. A lot of you take those at the very beginning of the year, but depending on what your schedule is for taking those RMDs, if it is at the end of the year, you do not have to take them if you do not need them, and they don't hit your taxable income this year. So that is a very good thing. As a result of that, that created a big tax planning opportunity for people to do Roth conversions in 2020. So if you are already counting on having those RMDs as part of your taxable income, and you're prepared and you've paid your estimated taxes, instead of actually taking that required minimum distribution, you can convert that into Roth. So you pay tax on that amount this year, and you convert that into the Roth account. Is a tax-free account when you ultimately take the distribution, and it grows tax-free. So the Roth is a win-win. A couple of different reasons why Roth conversions have also been very popular in 2020 is because our tax rates, again, under the Tax Cuts and Jobs Act, are still very low. And people are thinking that the tax rates are going to go up, whether it's after the act sunsets or whether it's going to be sooner than that under the new president. But I think that a lot of people are trying to take advantage of the low tax rates, and those Roth conversions are great. What a lot of my clients are actually doing is playing around with the tax rate, and instead of saying I want to convert, let's say 100,000, they're going to say, how much do I convert and still stay under 20% tax rate? So we kind of play around with different scenarios and say, for example, in your particular case, you may want to convert 200,000, and overall at the end, with all of your other income that's coming in, you're still going to pay tax effectively at about 20%. They're happy, they convert that 200,000 into Roth, and then now they are building up that bucket of tax-free income that's going to be coming in. The other nice thing is when you move some of that money from your traditional IRA into Roth, then that also reduces the amount that you have in IRA. So the calculation of your required minimum distribution for next year is lower because it's based on what is left in the fair market value in that IRA account. So Roth conversions have been super, super hot. Again, if you are still, and this is again for people that don't mind paying the tax and taking advantage of not having to include that RMD, but those folks that really want to save on taxes and are having a hard time paying, if you can get rid of that required minimum distribution, you can. So that's the number one thing that we're kind of seeing in the last couple of weeks. Also, don't forget that this is still very popular for those that are still having a hard time. You have up until December 31st to withdraw up to 100,000 from your IRA account. For those younger folks under 59 and a half, normally if you take anything out of your IRA, you would be subject to 10% penalty. So if that distribution is COVID, if there's a reason COVID related, and I'll read to you what that says, and we can talk about that in a minute. But if it is a COVID related distribution, you can get rid of that 10% early withdrawal penalty. And you do not have to include that amount in your taxable income if you are going to recontribute those funds to a similar, maybe the same or similar type of an IRA account within 3 years, okay? So where it's gonna get a little bit funky is how is that 3 year gonna get tracked? So who's really watching that you did put that money back? And if not, at which point does it become taxable? Do we wait till the end of the 3 years, or do we go back and tax it in the year distribution? But in any case, the nice thing is you do have those 3 years to recontribute that 100,000, and it's been fantastic. I know a lot of our clients who were, their businesses were closed or they were out of a job, they did take those distributions. So the COVID-related distributions, and this is what the rule says. So let me read that to you, and then we'll talk about that in a minute. So those distributions are made to an individual who's diagnosed with COVID, whose spouse or dependent was diagnosed with COVID, or those who experience adverse financial consequences as a result of being quarantined, laid off, have work hours reduced, or unable to work because of lack of childcare or the closing of the business or other different factors. So it seemed like it was pretty clear when this came out back in March, but it sort of opens up a lot of this opportunity to say, well, at that time I took the distribution, yes, I was furloughed, I was laid off, my hours were cut, my business was closed, my kid was home, but now everything is sort of back. So when they look at the end of the year, am I still okay taking these distributions? And I think the key here is going to be to document your circumstances, okay? And this is not something you have to submit with a tax return. That's also key, because people say, what document do I need to provide? You do not have to provide anything with the tax return, but you need to have enough documentation that if you do get challenged on audit, or whether it's a random audit or whatever the case may be, is that you have support of why you had suffered this, adverse economic circumstance. And maybe you did have COVID at that time, or your spouse or your child did, and you were home. So I think all of this, and it's a lot easier to document things now in the year this happened, again, as opposed to, say you get challenged 3 years from now, at that time you're going to forget what was happening and why you were adversely affected. So it's really nice to have all that backup document now. So don't forget, you've got up until the end of the year to do that. The other thing is, if you are working and you have 401k through work, and your 401k plan allows loans, typically you can take a loan up to 50% of the value of what's in your 401k. This year you can take up to 100% of the value. If you're actively working, what you do is you would have to reach out to the plan administrator, who's typically your HR person at work, and they can coordinate. There's a bunch of paperwork. So don't wait till the last minute to do it, or don't wait till the last minute to take stuff out of the IRA, because a lot of the paperwork, it has to be done ahead of time. And I've found too that last year, when people were trying to make contributions, distributions, and they got to that week between Christmas and New Year's, a lot of these financial offices were already closed for holiday. And the hours are very funky, because depending on where the holiday falls in the week, some offices are closed before and after. So we just recommend, don't wait. If you feel like you're going to need that, go ahead and get the paperwork going with your financial advisor or your HR person at work now. So that has definitely been a good. Any questions, Jo Ann, on that topic?
Well, let me just say though, on top of what you just said, everything this year is taking longer than you think it should take. So anyways, just because of COVID, whether it's people working from home or supply chain interruptions, like, you can't wait till the last minute on anything in this COVID time, let alone if you're going to try to make these distributions. Yes, the financial agencies are either skeleton crew or closed for the holiday, but on top of it, now they have different protocols with COVID, and maybe you need an appointment to go in there and sign something that otherwise maybe you just flipped in and out of the financial advisor's office. And now those offices, I know we work with several financial advisors, and many of their offices are still not open even for the advisors, let alone to the public. So give yourself time for those adjustments to be ferreted out. Alexis asked, would it be better to withdraw from your IRA account or your Roth account?
Definitely IRA account, because IRA account is what's taxable. Okay. So if you plan on putting it back so that it's not taxable, I would take it out of there. Your Roth account, is the distribution from it is not taxable, generally speaking. Depending on how long the Roth has been open, you may get taxed on some income generated in Roth if you're taking it out earlier, before you're 59 and a half. But if your plan is to put the money back, just take it out of IRA. Okay. I want to talk a little bit about the contributions, and we're getting into a holiday season where a lot of charities are asking for money, and charities do need a lot more this year. And because of that, under the CARES Act, there is a rule that you can deduct up to $300 of cash distributions above the line. So what does that mean? So when the Tax Cuts and Jobs Act came out and the personal deduction doubled for individuals. So it went from 6,000 to 12 for single filer, from 12 to 24 for married filing joint filer. It knocked out a lot of people from being able to itemize their deductions, which is mortgage interest, property tax, charitable donations. And that has resulted in sort of the adverse consequence, in that people were not really inspired to donate unless they were already of charitable nature, because those couple of hundred or couple of $1,000s of donations didn't do anything for them because they were taking standard deduction anyway. So in order to just, stimulate the deductions again and the contribution for charities in 2020, this rule came out in that you are going to get $300 deduction for charitable contribution, even if you take a standard deduction. So there's going to be a brand new line item on the tax return, and you can deduct up to $300. So I definitely encourage everybody, as we're getting into the holiday season, to donate to your local charity, and you're definitely going to get, even if you're take standard deduction, you'll be able to get the $300. For those folks that do large charitable contributions, this year they're also looking at a really good tax break. Typically, charitable contributions are limited to 60% of your adjusted gross income. The CARES Act took that limitation out. So if you are giving fairly large donations and they do show up on your itemized schedule, they're not limited. So you can deduct up to 100% of your adjusted gross income. You cannot create a loss with the charitable contributions, but you can donate up to 100% of your AGI with charitable contribution, which has been absolutely fantastic. Those contributions don't have to be directly to a charity. The contributions that are given to, let's say, a private foundation or any donor advised fund, where there's still a time lag between you giving money and the organization being able to use it, those are still limited. There's 60%, there's 50, there's 30% limitation depending on what the situation is. But the donations that are given 100% to charity don't have a limit this year. So this is definitely a good year for giving.
In that limit, is that for cash or non-cash donations?
Both.
Both. Get both.
Get both.
Even the IRS agrees with you. Get both.
The next item that I wanted to discuss is, it may get a little bit funky, but it certainly presents quite an opportunity: net operating losses. So we're talking about those folks that will have a business loss that was generated, and whether it's they're self-employed or whether they're S-corp shareholders or partners in a partnership, and at the end of the day on their personal return, they have this pass-through loss from the business, and combined with all of the other income that they may have, they create a net operating loss. So when the Tax Cuts and Jobs Act came out 2 years ago, what happened with these losses is you had to carry them forward. So you could not carry them back and recover some of the tax in older years, which has always been the rule in the past. So not only did you have to carry it forward and wait until the year where you're generating income, you also were limited to 80% of your taxable income in the year of the carry forward. So those were two fairly big limitations for folks that generated net operating loss. Well, when the CARES Act came out earlier this year, and they realized that a lot of people with a net operating loss would get some immediate relief by carrying it back to the years with higher tax and getting that tax refund, quick refund, or doing an amended return, they had opened that up. And in fact, because this loss is, it's kind of a disaster-based loss, and a lot of times when there's a disaster loss, you can carry it back 5 years. So the rule has changed to say that if you do have net operating losses from 2018, 2019, or 2020 year, you can actually carry those losses back up to 5 years.
Wow.
And in this way, when you carry the loss back in the years where you did pay the tax, you can get the tax refund quicker instead of waiting to generate income in the future years to carry it back. Now, let me also say that every situation is very different. We have a lot of folks that are making good money right now, and we anticipate that they will continue to make good money. So for them, the loss carry forward may still be the better plan, because if their tax rate is going to be higher in the future year, and that's what we're thinking, that perhaps that loss is going to be worth more to them in the future years. However, the folks whose business has suffered quite a bit, they may have had losses from the past, they want to carry them back and get quick refund instead of waiting to see what happens in their business in the future. The carryback is an absolute fantastic idea to do. So the timing of it, the sensitivity here is, if you look back on your tax returns and if you've got a loss on your 2019 return, so these are the returns that we just filed, if you've got a loss, you actually have up until the end of this year, up until December 31st, to do something called just a quick refund application. It is not an amended returns for the past years. It's a simple form to say, hey, I want to carry my loss back, and you pick the year where you have the income that you can carry it back to. But if you miss the December 31st deadline, it doesn't mean you cannot carry it back later. You can, you just need to file an amended return for those older years, which will take a little bit longer to process and to actually prepare. So this is why this kind of quick refund application form is faster and it's encouraged, and you always have up until the last day of the calendar year after the loss to file it. So for the 2019 loss, you have up until December 31st of 2020 to request that quick refund on the loss carryback. But I really do encourage you guys to look at your 18 year, to look at your 19 year. If you did have net operating losses in those years, if you feel like you think of carrying them back would be a better idea, we can do that. If you're going to generate more income in the future, just carry them forward. When it comes to 2020, one of the things that is also encouraged, back to organizing your documents, is if you've got a loss in 2020 and you want to carry it back, you can't carry it back now. You actually have to file a tax return to establish the loss number, and then you've got that to carry back. Mm-hmm. So if you've got a loss and you're going to wait until the extension deadline of September, you're missing out on your potential refund from applying for the carryback. But if you get yourself ready early and you prepare the tax return in February or March, we do the carryback. IRS is still going to be behind, so we got to give them some time. But at least in a few months, you'll be able to get some of that tax back from the years where you paid the tax, as opposed to waiting another 6 months to do it. So really, if you're going to have a loss in 2020, we again encourage you to get your stuff ready, get to your CPA, prepare the tax return. The CPA can do the tax return and the carryback all at the same time to get you some of that tax back. So it again may not apply to everybody, but I do encourage you guys, if you did have business losses in the past, to take a look at those. Any questions so far, Jo Ann, on any of the topics that I've mentioned above before we move on?
No, I just can't say enough how much the IRS is not responding right now. So in all aspects, everything that you can do to be proactive and be more accurate is going to leave you less frustrated, because I'm seeing on my side, people saying, well, this needs to be fixed, or I overpaid and now they're not applying it right and I want to go fight about it. And, things that used to be a simple phone call for me to just call and get straightened out now are taking literally months and months and months. And I'm getting yelled at because people are frustrated, and there's nothing, they're on skeleton crew. There are still entire service centers that are not open. I spoke with one gentleman in a business tax center who was incredibly helpful, but said, I am sharing a computer with someone regularly and we're no longer allowed to share. So that now that I'm back to work, this was back in the end of June, early July, he said, now that I'm back to work, my partner cannot come to work because she's not allowed to touch my computer, and they had to order her a computer and a phone, and it was going to take like 8 weeks. So even though that person was ready, willing, and able to come back to work, because the government resources were scarce in terms of electronics, that person couldn't come to work. So the trickle down is not just COVID and the closed in March. Like, the trickle down inside something as huge and slow and inefficient as the IRS, we're going to see this well into next year.
I agree. And I'm so glad that you mentioned that, because people do get frustrated, and I feel like we are stuck in the middle. What I noticed is that we can respond to those IRS inquiries, and IRS will take so long to actually read our response, but the automated system of notice generation is still on 30 days.
And that thing is not on COVID.
Exactly. The notices spit out every 30 days. So let's say you have a late filing penalty, and we can get it removed, but we cannot do it over the phone. Those requests have to be in writing. So we write a letter, and we have a lot of those standard verbiage that we help our clients with to remove penalties in different situations. We write and we put a request and we send it certified, and we see that they received it, and this is great. And another week later, the client gets the next 30-day letter, and then they call and they're very upset with us. And I completely understand that, but just taking this minute to say that those letters are every 30-day automated. They are not written by a human being. But the request to remove those penalties or read the whatever the issue is that we address has to be done by a human being. And that is where the disconnect becomes. And so just be patient with the IRS. I feel like as much as we feel like we've been doing catch up this year, all year, we are still on top of responding to IRS notices within the time, but we're always caught in the crossfire.
Well, and let me say, I give all the thanks to Miss Marion, because I use her line all the time with people. And I'm like, I hear your words. I know you're frustrated. I hear your words, but I can't make the IRS go any faster. Ruth has an interesting comment, and she says, do you think that with the new administration that's not so anti-taxes as this one, that the IRS will become more efficient? If the IRS becomes more efficient, you can have all of my things, my house, my car, my office. It doesn't matter who is in charge of anything. The IRS is the most inefficient operation I've ever witnessed in my life. And we're in the belly of it on the daily. I've been working with the IRS for 22 years. I have never, ever, ever, ever seen a change based on administration and how they process. In fact, over time, it's just gotten worse, because no matter who's in the presidency, their budget continues to get reduced. So they have fewer people, and as their experienced IRS agents retire, they are not rehiring in many cases, or they're certainly not rehiring people with any experience. So it's progressively gotten worse throughout my career.
Absolutely, absolutely. And I think and I forget what that number is, but there's a statistic of, a couple of hundred different laws actually get passed every single year, tax laws. Some of them we just don't know because they may not affect us or the clients, or some of them are clarification of the old laws, but there's a couple of hundred of those every single year. So the code has become a lot more complex, and the agents have become a lot more inexperienced. And their training systems are not efficient. And I do remember when this Tax Cuts and Jobs Act came out, 2 years ago, and there was very little guidance for the CPAs. So we as CPAs were giving guidance to each other. How do you understand this? No, I don't know. How do you understand this? We were talking to everybody and reading, all of the publications. And I remember talking to one of the IRS agents on the phone about something else and just asking him, like, hey, how are you guys handling this? What's your, he says, we don't even know anything about it. We have not been trained on it. We have not even read it. So it is becoming more complex, and there's less time for them to do it, which is very sad. And I just, my hope is, at least with the immediate thing that really gets people worried is, again, these notices. There's going to be a lot more penalties. People are filing late. People are not paying taxes. A lot of these provisions that we just discussed about, you can remove the 10% penalty. I see a lot of errors in our future about, you said no, but then IRS accidentally marked it as yes, they send a notice, you have to fight it. It's going to get worse after the 2020 tax filing season is complete, which will be next spring, next fall. So I feel like the notices are going to get more in volume and worse in errors, and I feel like we're going to get yelled at a lot more. So I'm bracing myself, and so I want to take this opportunity on the webinar to say that
bring vodka. Bring vodka to your appointment.
That's right. That's right. That may be the only thing to say. So moving on to the next item on my list is the bonus depreciation on the improvements. Now, this is affecting those folks that either have a business or maybe a rental property that have undertaken a lot of the qualified improvements. And what happened is when the Tax Cuts and Jobs Act passed 2 years ago, there was a glitch in the system that basically said that you can take a 100% bonus depreciation on all of the tangible assets, your computers and your equipment and your machinery and your furniture and stuff like that. But the qualified improvement property accidentally fell out of that list, even though it was included prior to the Tax Cuts and Jobs Act. So it was a glitch. And when the CARES Act was written, although it was not clean, but it fixed this glitch. So a lot of people who had the improvement property, who undertake an improvement on their rental property or their business property, were stuck with depreciating it over 39 or 27 and a half years, which was not what they had expected. They wanted to be able to write everything off immediately, and they got stuck in that glitch. So as far as the 2018 and 2019 returns that people had filed before the CARES Act came out, that depreciation was very low. When the CARES Act fixed the glitch, what you can do is go back, if you did have this improvement that you have done in 18 or in 19, and you had already filed a 19 return before you already know this, you can go back and look at your 18 and 19 return, and there's a couple of different ways to fix it. So just, think if you do have that improvements property, if you were not able to take proper depreciation on it, what we ended up doing is a couple of different clients that we knew had quite a bit of those improvements done. We went back and looked at their 18 tax returns, and some of them we had to fix. And there's like I said, there's a few different ways to amend it, whether you amend it or whether you can take a deduction in 2020, but you can fix it. But it definitely did create an opportunity to be able to deduct that. Now, these are the improvements that are kind of done to the inside of the property. They're not structural. So it's something that's not increasing the size of the building or, any structural reinforcement. They're definitely an inside improvements. But if you're, leasing a building, you can be a lessor, you can be a lessee, depending on who pays for it. It's your improvement. But if you're doing a lot of that build out and it can take thousands and thousands of dollars, and it makes a big difference whether you're able to deduct that 50 grand all in 1 year versus split it over 39 years. So that is definitely a big opportunity also as a result of the CARES Act.
Can you just list a few of those qualified examples besides, would it be things like roof or?
Yes, I think in the rental property, sometimes you can redo the kitchen and, yeah. It's not structural, but it's an improvement. You can change rooms, you can open up some of those internal walls that are not structural walls. That would be an improvement. Restaurant built out is a great example. If you can think about that, when the new restaurant moves into the open space, they knock everything out, they kind of rebuild where the kitchen is, and they put the tables in a different place. That's the kind of improvement. If it's an office building, you can, redo the conference rooms, move where the offices are, maybe knock out some of the walls, maybe build up some of the partitions. So those kinds of improvements would qualify here.
Oftentimes, if you think of it as things that would either improve the value, increase the value, or extend the life of the building, those are the kinds of things you would, not just paint, not just things that make it pretty, but things that actually add value or extend the length of time.
Things that kind of maintain it are always have been more of the repairs and maintenance. So if you have to repaint it, you should have already been able to deduct it without it being called an improvement expense. You know, so a lot of those are more repairs and maintenance. And so if we're talking about something that is more of changing the stuff on the inside, like Jo Ann said, you know, prolonging the life or adding value, but it's not structural, that definitely is an improvement. So that did create quite a bit of an opportunity for 2018 and 2019 expenses there. The other thing I wanted to mention is that, and I keep getting this, you know, some people are still doing the solar panels and solar, whether it's a business property or personal property, you do get a credit. The credit in 2020 is 26% of the cost. In 2021, the credit drops to 22% of the cost. And after 2021, the credit is at 10%. So I am not sure at this point if that's set to sunset at a certain, or if it's, I don't believe it's a permanent rule, but you know, we haven't looked into them too much into the future because people were very excited when it was at 30%, but it is now down to 26%. So I just, I have a few clients that were still doing solar panels, and I mean, that's pretty good. 26% of the cost to get us credit. And remember, the credit is always worth more than a deduction because the credit itself is an immediate write-off of the actual tax. It's not a write-off of your income, which then is subject to tax. It's a dollar for dollar reduction of tax. So, you know, if you put in a qualified, if you put in something solar and it's, you know, 100,000 and 26 grand, it's not a bad thing against your taxes. So it's still cash out of pocket though, so you got to be ready for that. But it's cash or tax. But that, just wanted to let you guys know that opportunity is still there, and just wanted to highlight that because those limits are changing and getting reduced as we go on. So those are kind of the 2020 hot items that I'm seeing with my clients. I wanted to cover a list of a couple of quick items that are always relevant and that I'm seeing as we're planning. So first of all, the timing. The timing of revenue recognition and the expense recognition is always a hot thing. And this year, it is particularly hot for those businesses that are doing really, really well. We have a lot of our realtor clients who are on fire and they're selling like crazy, and we're so happy for them. And now what can they do? In the case of a lot of realtors, as an example, where you don't really have a control over, you know, when the closing is set and when your commission drops. You're kind of happy to close when it's possible. But for those business folks that are in control of when their revenue comes in, maybe you invoice your clients if you're doing consulting. And so if you feel like you've already had a lot of revenue this year, hold off on that, on sending that invoice out till next year. And you know, you can, you know, same thing. For example, you're a builder. You may want to close construction on a home after the beginning of the year if you want to recognize revenue from that home next year. So as much as it's under your control, watching the timing of revenue recognition has always been key. But keep in mind that if you did receive payment for your services and you already have the check, and you don't take it to the bank, you'd still consider it received. So there's a kind of a concept that's called constructively received. If you have a check that's sitting in your drawer and you don't deposit it until January 1st, but the check is dated December 31st, you got it in December 31st in the year. So it's definitely think about that. Expenses, the same thing. A lot of the folks are looking, you know, that have made a lot of money are looking to push the expenses. A lot of the expenses, you know, they may not need anything big, but they're planning on undertaking, let's say, an advertising campaign next year, or, you know, maybe redoing their website. You can prepay for those things before the end of the year and take a deduction in the year that you paid for them, because most of our clients, small business clients, are on cash basis. So if you paid for your website, you know, by the end of December, and then your website guy starts working on it next year, you can definitely deduct it this year in the year that you pay. So prepaying for the expenses is always a good strategy if you're looking to move them ahead. And, you know, that works out so much better than buying stuff you don't need. I cannot tell you, because if you're planning on doing something anyway, and you have the ability to prepay it, do it. But Jo Ann knows I'm always of the mindset that don't buy something you do not need just to get a tax write-off, because whatever your tax rate is, say it's 20%, you're only getting 20% benefit of the cost. Meanwhile, you still need to put out 100% of it out of your pocket. So if the things that you need for the business, will definitely take advantage, and playing around with timing is a great idea. Retirement contributions, fantastic. If you are looking to reduce your income and put into a retirement plan, keep in mind the deadlines. If you've got a 401k plan and you're an employee, that contribution needs to go before the end of the year. The employer match can go after the end of the year, so you have some time. Same thing if you've got a simple IRA. So anything that has an employee piece to it needs to be in the account before December 31st. As an employer, so anything that's like a SEP, self-employed pension plan, or an employer portion of the 401k or simple IRA, that can wait until after the end of the year. So there's no immediate rush on that. You can still set up some of those retirement plans. Some plans, I know I was talking to some folks and they were looking at doing a solo 401k, and I said, no, I think you should already have had this plan. And they said, one of the financial advisors said, no, we can probably still set it up. I don't know if it's true or not, but if that's something you're looking at, you may want to look at the time frame of when you can get the plan set up. I know SEPs you can set up anytime, but again, SEP you can contribute after the end of the year. Health savings account is another great opportunity. If you've got a health insurance plan that is high deductible plan, set up health savings account. It's $35.50 that you can put in and take a deduction for as an individual plan, $7,100 for family plan. Again, you don't have to contribute before the end of the year. You've got until April 15th to do that, but you may want to open an account now and do that contribution. And that is so much better than trying to deduct your actual out-of-pocket medical expenses that will be limited. So deducting the contribution into the health savings account, which then you can use to pay for those medical expenses, gives you the tax break on that. So those are kind of some of the basic things that we're doing right now, but I definitely wanted to spend a little bit more time on those 2020 ideas. Questions, Jo Ann?
Yes, I want to give you a 2-minute restricted window because I don't want to get this out of hand, but can you talk for 2 minutes on PPP loan forgiveness and how that will affect people's taxes in 2020 versus 21?
I think we're going to try and have kind of a quick pop-up webinar in the next couple of weeks.
Sure.
The latest thing is the IRS came out with a, I guess, clarification notice, which really didn't clarify a whole lot. But the idea is that if and this was at the beginning, is if you use the PPP money to pay for the expenses and that PPP is going to get forgiven, you really cannot deduct the expenses that you use government money to pay. So although they said the income from forgiveness is not taxable, but the expenses are not deductible. So it's 6 half dozen the other, because the net bottom line to your net income is the same. So people are still very upset about that. Well, what happened when they came out with I guess this notice or clarification last week or 2 weeks ago, is that even if you don't apply for forgiveness, but you think because you've got all the factors that your loan will get forgiven, you shouldn't be able to deduct these expenses that the PPP funds pay for. So until we hear further, and people are still fighting about it, and we still have hope that that will get fixed next year, as we are going to go through the 2020 tax return prep. But the way that we're looking at now with that rule is to say, look, there's no rush to apply for forgiveness. In fact, we're encouraging people to kind of wait, because depending on what happens, if you have to pick up that expense and income anyway in 2020, then there's really no rush on doing the forgiveness application before the end of the year. But if the rule turns around where it says that you have to wait for the application, at least you would have pushed that impact into next year. So that's kind of our position. And we already have a couple of clients who've applied, a couple of clients who've gotten approval on the forgiveness, and that's fine. But I think people that are now starting to get out of their loan period and applying for forgiveness, we're just saying, there's really no reason to do it before the end of the year. You can wait, but if you think it's going to get forgiven, we'll have to pick up that, not deduct that expense. So that's the quick and dirty of it at the moment.
Beautiful. Well, thank you so much as always. It's always good to have a recap, and this is good even if you're new in business and this is your first year to prepare a business return. Some of these are tried and true old faithfuls that we always use. So and mixed in with some new fun. We will wrap up today to be respectful of everyone's time. I just want to point out to you that we will be back with you next Tuesday, and we're going to be talking about for sale by owner contract considerations when it comes to real estate. So you'll get the week off next week, MP. You know, oftentimes folks engage in transactions, private party, and the benefit of that is obviously on some of the cost savings when they're not involving real estate agents. But when you're not involving real estate agents, there's some hand-holding and some considerations that you need to make sure that you've taken care of. So it'll be Jackie and I next week. As always, our webinars are recorded and will be distributed on our KoontZassociates.com and KoontzParkin.com websites. They'll be on our Facebook pages and on our YouTube channels as well. So we will leave you with that. We hope it was helpful. If you have topics you'd like to hear about, please email us and let us know. And we'll see you next Tuesday.
Thank you.
Thanks.